Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. Today, we'll start studying how to report equity and investments into your financial statements. And for understanding this, we must first understand what are the different types of shares that a company might have in the equity. The first type are authorized shares, and this is the number that the investors or the shareholders have authorized for a company to have. But a company may not have all of those. It's just an authorized number. They may choose not to issue them. And that comes to the second point. The issued shares are the ones that a company already sold. But there may also be a small difference between the shares issued and the third type, which are shares outstanding. The shares outstanding are the ones that are already in the market, but a company may have shares that are issued, maybe for compensation or other things that are still not in the market, but may be in the future. So three types of shares: authorized shares, issued shares, and shares outstanding. When we're usually talking about shares in the market, we refer to them as the common shares. And these common shares are going to give you three things. First one is voting rights. Usually, if you have one share, you have one vote. And when you hold shares, this is going to give you the capacity to vote in the board member community into decisions that are going to be taken into account for every company. The second thing that you might get from a common share, and this one's optional, it's going to be dividends. So dividends are going to be the payments that a company may decide to give you or not for having that share, and dividends are going to be part of the money that was earned by that company in their net income. And then the third thing that you may have is the residual. So let's say a company goes bankrupt and they have to pay back to all of its people. As part of a common share, you would get the residual of what's left. Of course, you have to understand that the first people that are going to be paid are the creditors or other types of shares that are called preferred shares. What you're going to get as a common shareholder is going to be the residual after all of those first people were already paid out. And I just mentioned an important concept that I'm going to go back to: preferred shares. What are those types of shares? Basically, they're also similar to the common shares, but these ones have a priority when relating them to the common ones. And this priority, it's going to appear in the dividend and the liquidation preference. So you may have preferred dividends. These ones are going to be only for the preferred shareholders. And in the liquidation, you would get preference over those that had the common shares. But these ones may also have the call and conversion feature. So now, let's talk about all the things that you can do with shares. The first thing is that you can issue all the shares. And shares are usually issued in exchange for cash or other assets that the company might use for financing itself. The increase in equity may impact multiple parts. So the first thing that you must consider when reporting the share issuance is that you'll have an effect on cash because you'll have this new money coming into your account. Then the second thing is that you're going to have an effect on the common shares, which is a contributed equity. And here, we're going to do the par value, which is a standardized value kind of that companies make up. It's going to be the minimum amount in which they would issue a share, but it's usually a very, very small amount. And you're going to multiply that par value times the number of shares that you issued. And this, it's going to be called common stock at par. And then the other part that you're going to influence in your statements, it's going to be also in the equity, but this one will be called paid in capital. And the paid in capital is going to be the remainder. It's going to be the cash that you received minus the common shares that you already did, the common shares at par, and this is what's going to be called the contributed surplus. So 3 things will be affected when you issue shares. First, your cash that you're receiving for the financing, but also the common shares and the paid-in capital. Now, if you did share repurchase, which means a company that's buying back its own shares, and this is also referred to as the treasury shares, this is never going to impact the earnings. What it will do is that it will affect cash and the contributed capital through a decrease in the treasury shares. So if you got all of the share repurchases, we're going to first decrease that amount from cash by the full amount that you paid from the share repurchases, but we're also going to balance it out in the treasury shares section in the equity, and this is going to be also the full amount that you paid for those share repurchases, but it's going to be in the category that's called treasury shares. Now, there are 2 main things that you may look at shares, or there are 2 ratios that might be interesting for you if you're a shareholder or if you're emitting shares and issuing shares. And they're going to be the EPS and the diluted EPS. EPS, it's going to be the earnings per share. And what this ratio wants to say is that earnings per share are going to give you the amount of earnings that you had minus the preferred dividends, and all of this, you're going to divide it by the weighted average number of common shares outstanding. That's what's going to be a basic EPS. And this ratio is going to be probably one of the most important ones that you'll care for as a shareholder, because it's giving you how much money is a company creating, basically, or earning in exchange for that one share that you have. Or if you have many, well, then you would be creating all of this earnings in the company. But I just mentioned another concept that's called the diluted EPS. Diluted EPS is a measurement of a company's earnings per share if all the convertible securities were converted in that company. And so a dilution is going to devalue a shareholder's existing equity, and it will in turn reduce an EPS. So this is usually considered a conservative metric because it kind of shows what an EPS would be in the worst case scenario. So it's going to be an important value also for shareholders, because the EPS, it's the current state. How much money is the company earning for your own share? But the diluted EPS will in turn give you the worst case scenario. So if that one's good, it means that things are going pretty well for your company. And now, this is going to allow me to turn into the second part of this episode that I wanted to do. And it's not when you're issuing those shares or repurchasing those shares, but when you're the investor. So let's imagine Warren Buffett or any of those investors that are investing in equity. And for understanding this, you first have to know that there are 3 types of investments in equity. The first one, it's a passive investment. And passive means that you have a minority ownership. And minority might be anywhere under 20. And this is going to be what most people have. Even Warren Buffett, that owns lots of Apple shares, he only has around 5%. So he is a minority owner in Apple. And when you are a passive investor, you're going to account for the earnings or for all of those things that we're going to see later with the fair value method. The dividends are going to be recognized in the income, and the fair value will be adjusted throughout the net income. But I'll later go into details with this. The second type of investment that you may have is significant influence. And so, as the name suggested, here you have a significant influence in the company, and this is considered anywhere above 20%. So if I hold 30% of a company, I do have significant influence over that company, And for doing this, we're going to apply the equity method, which is going to be another method where the income will be recognized based on a percentage of the earnings. So if I owe 25% of a company, I'm going to report 25% of that company's earnings in my reports. And then the ultimate and last method of investment, it's going to be the control. And the control means that you control the majority of that company. So holding over 50%, technically over 51% of that company will give you the control. And when you have control, what you're going to do is a consolidation. You're going to include all of the company's statements, all of its assets, all of its liabilities, all of its earnings into your own statement. So this is usually what happens when big companies get control of a smaller company. You'll see that all of the company's earnings and assets and liabilities have embedded the other smaller company that they control. Let's put an easy example, Whole Foods and Amazon. Amazon got control of Whole Foods, and so if we looked at Amazon's financial statements, we would see embedded somewhere over there that in their earnings, you would see Whole Foods earnings. In their assets, you would see Whole Foods assets. And in the liabilities, you would see Whole Foods liabilities. So you're already including all of the other company in your own statements. And this one's going to be the easiest because it's called consolidation. But let's look at the other two methods. First, for the passive investment, you would have the fair value method. And for the fair value method, basically what happens is that I buy shares. So I pay cash and then I get a non-cash asset, which are going to be this, shares. But then when the value changes, the fair value changes, we're also going to change the value in the non-cash asset that we already have, and we'll balance it out with an unrealized gain or an unrealized loss. And it's unrealized, the name is very important because you technically haven't sold it yet. When you get dividends, then you would get that as cash and as revenue because that's apart from what you care. That's just extra money that you receive. But if you sell the shares, now we would see that the non-cash asset, it's going to be modified. But finally, you're going to realize all the gains or losses that you had from the sale. And so this one's going to be the difference between the cash and the non-cash asset. And the non-cash asset, basically, it's going to be the sum of all the values that you have, and those values are going to include all the fair value changes. So the important part here is that after all of this method, you would have a total earnings impact, which is the sum of the retained earnings, and this would consist of the dividends, but also of the capital gains. Now, this same value of the total earnings impact, which is going to be the value that you get in the retained earnings, it's going to be the same through the equity method, but this method changes a little bit. Because remember, in this one, you already have significant influence. If you didn't have a significant influence, you would have used the fair value method. If you do have significant influence, you would use equity method. And so for equity method, you won't put any changes with fair value changes. But what you will do is that you will do changes when you have reported earnings. So a company shows out its statements and shows all the earnings that they got from that period. Then you're going to take a percentage of those earnings and put it into your own statements. So if I control, as I said, 30%, I'm going to include 30% of the earnings into my statements. And it's going to be always the same amount that you have either in the income or a non-cash asset that's going to be a percentage of the part that you control. And the only thing that would differentiate it would be this, because if you then sell those shares, you would also have an impact in the non-cash asset that you have of your stocks, but also you would then put the realized gain or loss, which would be the difference in the sell. So even though the last thing, it's always going to be the same, the realized gain or the profits, How you account for it in the meantime, it's going to show the difference if you have a significant influence or if you're a passive investor. As I said, the easiest one would be the control, because here you would have full ownership of the thing, and then you can just include it and embed it into your own statements.